Something extraordinary is happening in the gold and silver markets right now, and for the first time, the warnings from Andy Schectman and Alasdair Macleod aren't just analysis. They're playing out in real time. For years, both experts have warned that the paper-based pricing system behind gold and silver was stretched beyond its limits, that physical demand would eventually overwhelm the synthetic supply created through futures, rehypothecation, and leveraged positions, and that one day the world would see the difference between paper metal and real metal. That moment has arrived. According to recent market data, silver has surged to new all-time highs, while global inventories have tightened to levels that major exchanges haven't seen in modern history. Delivery requests on COMEX exploded. More than 36 million ounces of silver demanded in one shot, alongside nearly 60 tons of gold standing for delivery at the same time. And right as this pressure peaked, the unthinkable happened. The CME system, the backbone of global futures trading, went dark for 10 hours during the exact moment of the largest physical demand spike of the year. Analysts may call this a coincidence, but according to Schectman and Macleod, the timing is anything but random. It lines up precisely with what they've been warning about. The moment the physical market begins to overpower the paper market, the moment the illusion of abundance collapses, and the moment real metal starts dictating the price instead of leveraged contracts. This isn't just a rally. This is the early phase of a structural breakdown. Today we're going to break down exactly what their message means, how the global precious metal system is changing, and why this moment could mark the beginning of one of the most dramatic repricing events in modern financial history.
We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I think the markets are showing huge, great strength.
If you were to see silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600, 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation.
This situation begins with something Alasdair Macleod has repeatedly emphasized: rising prices accompanied by falling open interest. According to Macleod's latest analysis, gold's open interest sits near 420,000 contracts, a level typically seen during price exhaustion, not at the start of a breakout. Silver shows the same pattern. Under normal conditions, speculative rallies push open interest higher. Traders pile in, hedge funds load up on leverage, and futures positions multiply. But not this time. According to the latest COMEX data, open interest is shrinking even as prices rise, which means something entirely different is driving the move. Contracts aren't being opened, they're being closed. Shorts aren't adding, they're retreating. And buyers aren't trading paper, they're standing for physical delivery. That's the core of Macleod's message. When prices rise with collapsing open interest, the physical market, not the paper market, is now in control. This is rare, and it is the clearest sign that the leveraged system that has dominated precious metals pricing for decades is beginning to lose its power. At the same time, Andy Schectman has been highlighting another critical pressure point: the collapse of inventories. According to Schectman, both COMEX and LBMA silver stocks have been draining for months, with London's silver inventories falling to decade-low levels and registered COMEX stocks shrinking as large players quietly remove metal from the system. China, according to refinery contacts Schectman works with, has been pulling silver out of London at an unprecedented rate. The Shanghai Futures Exchange, according to its latest reports, has experienced one of the fastest drawdowns in its history. Now combine those facts with what just happened on COMEX. According to official delivery statistics, in the first 2 days of the December cycle, nearly 24,000 gold contracts, about 2.4 million ounces, stood for delivery. Silver demand was even more extreme. More than 8,300 contracts, representing roughly 41 million ounces, demanded immediate physical settlement. To put this into context, November, normally a slow delivery month, saw almost 20 million ounces of silver delivered and more than 1 million ounces of gold leave the exchange. These aren't traders. These aren't momentum chasers. According to Schectman, the sizes and timing of these delivery demands match sovereign-level interest, likely Eastern players, possibly Chinese-aligned entities who prefer physical metal over Western promises. And the most interesting part is where the rumor of the 36 million ounce Stanford delivery started, Shanghai. According to multiple sources familiar with the matter, word was circulating across the Shanghai gold exchange hours before the Western markets reacted. Then came the CME outage. According to the official statement, it was a cooling failure in a data center. But according to engineers who design these systems, major exchanges don't collapse from a single cooling loop. They have redundant loops, backup generators, mirrored data centers, and automatic failover protocols. A total outage across all systems is extremely unlikely. A 10-hour outage during one of the largest delivery events of the decade strains credibility even further. This is where Schectman's and Macleod's insights converge. According to both analysts, the Western gold and silver markets rely on a system where 1 ounce of metal can be legally claimed multiple times through rehypothecation. As long as very few people ask for actual delivery, the system works. But once physical demand spikes, once too many people start opening the cookie box, the illusion collapses. Schectman describes it simply. If too many people open the box at once, the world discovers there aren't enough cookies to satisfy the claims. This is exactly what's happening. According to Macleod, the combination of shrinking open interest, rising prices, massive delivery demands, and rapidly falling inventories suggests that the derivative structure may be reaching the end of its elasticity. The shorts can't roll forward easily, liquidity is thinning, and the buyers are not leaving. They're standing for metal. Then comes the geopolitical layer. According to recent reports, multiple countries including Italy, Germany, Hungary, Turkey, and India have been repatriating gold. This is not normal behavior during stable times. Nations repatriate gold when they don't trust the system, when they expect volatility, and when they want the metal physically inside their own borders before monetary conditions shift. China's role is even more significant. According to shipment data, China has been pulling silver out of London and absorbing global supply at a pace that suggests strategic accumulation, not market participation. And according to SGE insiders, rumors of large Western delivery stands are often known in Asia before the West reacts, revealing just how global and interconnected the informational pipeline truly is. Layer all of this together, and the picture becomes clear. The physical market is asserting itself. The paper market is weakening. The derivative system is under stress. Vaults are draining. Delivery requests are exploding. And major exchanges are experiencing failures during peak stress. According to both Schectman and Macleod, this is the scenario they've warned about for years. The early stage of a monetary reset, where gold and silver revalue sharply to reflect their true scarcity and their role in a world where trust in currency and institutions is breaking down. Silver at $96? According to Schectman, not crazy. Silver near $600 based on geological ratios? According to Macleod, mathematically consistent in a market where paper supply disappears and only physical metal matters. This isn't a future prediction. This is a description of what is unfolding now.
In both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. I mean, it's obviously a little bit, but I mean, it's tiny, if anything. I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that, particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events. Silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets.
Yes.
And there was, actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver. And I reckon that that's going to tip the market up, or whatever I say, but you can see how the rumor might start there.
Yeah.
And confirm, if you like, that it's Chinese sources who actually went for it. But the other thing that's fascinating is, was it just coincidence that a data center had to shut down because it was overheating? No, I read somewhere by someone who is supposedly an engineering expert on cooling systems that data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system, it's a bit fishy.
Only 2 days, well, today's day 3, I don't have the numbers yet, but 2 days into the December delivery month, and there's already been 23,970 gold contracts that have stood for delivery. That's 2.397 million ounces, and plus 8,305 silver contracts, or 41,525,000 troy ounces issued and stopped so far, and the month has just started. It's also relevant to note that in November, which I would say was not normal, the silver deliveries ended the month at just under 20 million ounces, about 19.7 million, which it's really crazy because November is not a scheduled delivery month for either silver or gold. There was 1,267,000 ounces of gold delivered. Issued and stopped is the correct terminology. But the first day, this month, the December contract, day one, we saw 7,330 contracts stand for delivery in silver, which is 36, almost 37 million. That's more than $2 billion worth. And although it's not a record, it's close to it. April was the biggest record of just under 12,000 contracts. But to see a 2-day, that's day one, and 2-day obviously added more, but it's just insanity, where there's already been 2.4 million ounces of gold and almost 42 million ounces of silver delivered in 2 days. This is the same type of volume that we've seen all year long. And, it's funny, you and I started talking about this in 2020 before anyone did. And now it's just mainstream mainstream in our business. And I think this will continue until it doesn't, meaning until stuff is just depleted. And it's becoming more and more obvious that this is an imminent deal. At the same time, you have one of, if not the largest short position in COMEX futures market, along with a massive short position in SLV, one of the largest ever. And at the same time, you have the LBMA, which is running on fumes. And, it's a situation where the delivery via mechanisms are breaking down. Almost 90 million ounces have been delivered off of COMEX this year, and since October, pardon me. And I don't know, since October 1st, 90 million, it's accelerating at a level that I don't think people understand or take for granted. And I think the way that you break that up is just to simply say that, let's make an analogy, right? For years, everyone pretended that, let's call it a cardboard box was full of cookies. There's a picture of a cookie on the outside. And the thing of it, and they would trade that. But now everyone is saying, no, I want the cookies. And people are realizing that the box is pretty much empty. And when that happens, this pretend cookie game, which you could call the derivatives, falls apart. And real cookies, gold and silver, become much more valuable. And that's why prices are rising. And why the dollar and other currencies may look weak when the truth comes out. So, yeah, I think it's a big deal. There was this report that JP Morgan shifted its offices to Asia in the middle of the night, that they were told that the people had like 5 days to move their family and everything to Singapore. I believe that is false. So everything that I'm reading tells me that that's not true. I guess we'll find out and we will see, but I know a lot of people have been asking about that. The bottom line, then again, to me, is that the market runs on trust. And when you believe that you'll get delivery of what you were promised, and that trust has been built up over decades, then the system works. And you buy a contract, you can stand for delivery. The metal's there. That's why COMEX has set the price of gold and silver forever. And the analogy is like a bridge that handles a whole bunch of weight until it doesn't, like the 35W bridge in Minnesota that collapsed that I drove over 5 million times. And you're seeing that in London. You're seeing that in the COMEX now. And I don't know. I think that this is going to be a story that gains a lot of traction over the coming weeks and months. I think that the price of silver is just beginning. I really, truly, truly do.
As these events continue to unfold, the signals are becoming louder, clearer, and harder to ignore. According to Andy Schectman and Alasdair Macleod, the stress we're seeing today is not temporary volatility. It's structural. The physical market is exposing the paper market's weakness, and once that shift begins, it doesn't reverse. It accelerates. We may be entering one of the most important moments in modern financial history, a moment when gold and silver no longer trade as commodities, but as anchors of trust in a system that is running out of time, liquidity, and credibility. The coming repricing will not wait for anyone. It will not move slowly, and it will not look like anything we've experienced in our lifetime. If you want to follow this transformation with clear analysis and understand what it means for you in the real world, make sure you subscribe. What's coming next will be even more revealing.